This is not financial advice. I'm recording my thoughts about Twilio, which is a communication software company. I did two videos in the past when the price was at $200 and $112, and both the times I said it's not a buy. But today it's trading at about $85, so I want to reevaluate and see if it's in the buy zone. At $85 per stock, the market cap is about $15 billion. When I look into their revenue in the past 12 months, they made about $3 billion of revenue, which represents a price to sales of about 5, which is good. But when I look into the net income, they made about negative 900 million. So there's no PE ratio as such, but since this is a growth company, we can expect that it's in the negative territory. Twilio stock fell because it's heading in the wrong direction in at least 4 aspects. The first aspect is the growth rate. They are growing at about 60% in the past, but now the growth rate is coming down to about 45%. But Twilio for long term is only committing about 30% growth for the next few years. So we can see that the revenue growth is decelerating. The second is the stock dilution. In 2020, they only had about 140 million stocks, but today it's about 187 million stocks. That's more than 30% dilution, and we have no proof that they wouldn't do it again, right? Stock dilution hurts, so they're heading in the wrong direction in that as well. Number 3 is the gross margins are flat or even reducing. This is a software company, so we assume that their gross margins would be pretty high, right? For example, Google's gross margins are about 80%, but Twilio's gross margins are stuck in the 50% range because the carriers are taking more cut, and they are also facing a lot of competition from their competitors like MessageBird, Nexon, etc. So this is not a good sign that their gross margins are stuck. Number 4 is net income is heading in the wrong direction. They lost about $400 million in 2020, and in 2021, the losses doubled to about $900 million. I understand that they have acquired companies like Segment, but we don't know whether those acquisitions will pay off or not. So at the moment, this is still a negative point. So let's look at the reward in 2025. They're only committing to 30% growth rate in revenue in the next 4 years. So I'm going to assume the same 30% revenue growth. The revenue in 2025 would be about $8 billion. Since the gross margins are stuck in the 50%, I can only assume 20% net profit margin. So with a net profit margin of 20%, they would make about $1.6 billion of net income. With respect to multiple, this is a company that's growing at 30% year on year and has gross margins in the range of 50%, so I can only assign a multiple of 20. So with a multiple of 20, this company would be worth about $32 billion or $177 per stock. But wait, the stock is at $85 now, right? So that's about 2x in 4 years, but I have to deal with an incredible risk of execution with this company, right? Finally, these are my thoughts. I'm looking at a 2x reward with Twilio, but with a lot of inherent risk of execution. These days, Google is trading at under 20 PE, and that can also 2x in next 4 years with much less risk than Twilio. So if I want to invest in Twilio when compared to Google, I want to have more reward, like a 3.5x or so. So if this stock falls below $50 or so, then I'm looking at a 3.5x, and I can take that risk to get a better reward, which is 3.5x compared to Google, right? So at the moment, I don't see good risk reward, so I would rather put my money in Google than Twilio.